Okay, so we're going to go over mortgage rates and the 5 questions you really must ask or get caught in the marketing trap, and it will cost you thousands, realistically tens of thousands of dollars. And so you need to be aware of what to ask so that you are comparing apples to apples when looking at mortgage rates. There are 5 key things we're going to go over. We're asked this question all the time, and the key thing here is as long as you go in understanding what to ask, you'll be able to make the best business decision for you and your family. So with that, hey, make sure you hit subscribe, make sure that you hit the like button, share this with somebody if you know that they're looking at purchasing a home, if they're looking at doing a refinance, so that you have a very clear understanding and your friends have a clear understanding of which lender is going to offer you really the best program. So let's get to it. So first, you need to compare rates at the same time and day. So if you've ever heard of this thing called the stock market, you will know that it goes up and down every single day. Now, you look at this and say, listen, are really rates different in the morning than they are in the afternoon? And the answer is absolutely. In fact, 2 years ago, Dan and I did, Dan Golden at Cornerstone Lending and I did a special session because there was a 2-point swing in the morning to the afternoon. It was crazy. I'd never seen anything like that in my 27 plus years, and neither had he. And so that required us to do a special session. So understand, when you're quoting rates, you must quote them at the same time and day, because like the stock market, it goes up and down all day long, every day. So understand, if you're going to compare apples to apples, that is rule number 1. Rule number 2, when you get the rate, you need to ask, what is the cost of the loan? What are the discount points? Okay? Because I know this seems funny, but there's this thing called marketing, and their intent is to go ahead and market to you because they will have a captive audience, knowing that these interest rates have a very global impact on your family's budget, and so everybody wants to get the best rate. They will give you what we call a teaser rate, and you need to ask, what are the discount points? Now, to make sure that we're on the same page, 1 point equals 1%. So if you have a half a point in fee, you have a 0.5% of cost, whether that's in the fee that you pay or in rate, depending on which one you want to go with. Okay, so if you go with rate, your rate is higher, it goes to par pricing. If you pay the fee, then you get the lower amount, but that is cash up front. As an example, if we use $500,000 as a loan balance, and they say, oh, well, you can get 2.6%. Par pricing today is 2.875. Okay, so let's pause here real quick. Some of you might be saying, if you're watching this, a couple of months down the road, a year down the road, you might say, oh, this is not real, this is not relevant. It is. It's just today's pricing may not be what it is tomorrow. Well, guaranteed it's not. And it wasn't what it was last year. Last year we were at 3.5, and now we're down to 2.8. 2 years from now, we might be at 5%. The rate doesn't matter. It's the logic and the questions that, that do matter, because the questions never change. The rate does, but that happens every day and multiple times during a day. So it's the question. So it is more evergreen. The information is valid. Just the questions are what need to be asked as you're comparing rates. All right. So today is 2.875. All right. If the cost to get to, say, 2.6, they say, oh, there is a cost of 0.375 in points. Okay, well, that translates to $1,875. You might say, oh, that's not a big deal. I'm okay with that. Perfect. But just to give you an example, a mathematical example, so if if they said, oh, it's 1 point to get to, 2.6%, okay, well, that's $5,000. You might say, maybe it's not going to make sense. Maybe it does. It's a business decision you get to make. You amortize that over. What is the repayment cost of that? How long? And normally, anything longer than 2.5 years, I normally say most of the time that's not worth it. It just depends, again, how long you'll be in the home. All right. So you need to ask, what are the rates? So as an example, and Marie will post a couple of these, we have, hang on a second, we get to this one. Okay, so we have this one, and current pricing for 30-year, 2.875, and look at that, they're actually charging 3.75 to get to that rate. So this is the discount price, this is the cost. So again, if we looked at this, you might say, okay, I'm willing to buy that down for $1,800. Okay, I'm good with that. Okay, but if it was more, you might feel differently, all right? It's a business decision depending on what other options are available. Then we come down to loan to value, and you're like, well, what do you mean? Well, understand mortgages and mortgage interest rates, actually, I should say, are based on risk. The higher the risk, the higher the rate, okay? So if you have a low credit score, your interest rate is going to be higher. And you're like, what? Absolutely. And as much as the amount that you put down is having an impact because it's the risk. The more you put down, the less risk the lender takes, the better the rate. So funny enough, people look at it and say, hey, you know what, I'll put 20% down, I don't have MI. Yeah, did you know that if you put 5% more down, you get a interest rate break? That might make more sense to you depending on your assets and liquidity and basically what you're doing. That could have a bearing or a big impact on things. So to keep that in mind. So we could do a 95% loan, my rate is going to be higher. My mortgage interest rate will be higher at 95% than it will at 75%, 80%, or 70%. Because again, it's based on risk. So you need to ask the question, what is the loan to value, the LTV, loan to value? What is the LTV for that rate? Hang on a second. If I come over here, and we look at this one, make sure you guys can see that. There we go. It says on this one, to get a 30-year fix, we have a $500,000 maximum loan amount. Oh, okay. And that means maximum 75% LTV. That means that you would have had to have put at least 25% down. Isn't that funny how we got to that number? And you had to have a credit score of over 760. Okay. Well, if our median price in this area is closer to about 950, Seattle 850, South King County, Pierce County, closer to 585, 600. When we look at Everett, Arlington, Marysville, those areas, we're looking at a similar 550 to 600. Well, in the lower priced areas, sure, you can put 25% down, that makes sense. And in the east side or Seattle areas, you got to put a lot more down to get that rate. So the reality is you may not qualify for that rate. So you need to make sure that you're looking at not only what the loan to value is, right? You have to compare that at the same day. What is the cost? And now we're going to get to the next, or this one, well, we'll skip one. Credit score on this clearly said you have to have a 760 credit score or better. So if you're at 750, you don't qualify. You don't qualify for that program. In fact, if you don't meet any of that criteria, you don't qualify for that program. And that's what lenders do. They look at that and say, hey, look at this rate. This is awesome. You can have it. But in the small font, in the small type, it clearly states what the restrictions are. And they do make it tight. And they do make it very, very difficult to get that program. Why? Because they know only a certain select number of folks are going to qualify for that, but they got you to call. They're able to capture you. They're able to take an application. And then they get you on the, oh, to get this though, you have to pay this. And that is a different game. It's called marketing. And you need to be careful of that because that is their goal. That's why they pay dollars to market to you. All right, we talk about loan type. All right, so a classic one, if I go back to this one here, this is this is classic. So understand, conventional is one type of loan. You have VA, which is one, for veterans. Those are vets, and we thank you for your service. They get a special kind of loan. Then you have FHA, sometimes called HUD, but you have an FHA loan, even a USDA loan, all federal backed. VA, USDA, and FHA are all federal backed programs, okay? They offer different rates depending on, well, because they have different applications. But let's take, for example, make sure I'm in the picture there because Marie will do this. Notice that the VA rate, par pricing, right? No cost, par pricing, 2.25. Yet down here for 30-year conventional, 2.875 with 3.75 in fee. That's a big deal. So again, the type of loan that is being advertised is super important for you to understand. You might look at the VA rate, oh my gosh, 2.2%, that's awesome. But maybe you don't qualify for a VA loan. Maybe you're not a vet, you did not serve. Or you're already using your VA benefit and you're buying a different property or whatnot. Okay, if you don't qualify for that loan, well, you're back to where everybody else is, okay? Understand, loan type has a massive impact on rate. With that being said, understand then when you're comparing same day, same time for rate with what is the cost to get that rate, with what is my maximum loan to value for that rate, what is the loan type for that rate, and what is the minimum credit score I have for that rate. You should do an Excel spreadsheet or just do columns, right? And if you're going to start calling and you're going to start checking rate, have this as each one of the headers and start going across and say, okay, Dan Golden with Cornerstone Lending, his par pricing 2.875. There's no costs, there's no discount points. It's conventional. You need 20% down. Perfect. You go to Juliana, it might be the same thing, Qualstar Credit Union. Then you go to, I don't know, First Tech or somebody, and if they're not needing loans, they're not, offering these amazing temporary interest rates, you may find out, oh, wait a second. To get 2.875, it's going to cost me a half a point or 0.375. Well, okay, so that's not as inviting. But now you're comparing apples to apples. Oh, shucks. Dan doesn't need anything greater than a 700 credit score, but this other lender needs 750 minimum credit score, and I'm at a 725. Well, guess what? You're not going to qualify for the program, so you're not going to get that rate, which means you're going to pay a higher interest rate. So remember, you must ask these 5 questions very clearly, same day, same time. What is the cost? What are the discount points? What is the minimum loan to value? What is the loan type? And then, of course, what's the minimum credit score to qualify for that program? Those are the questions you need to ask every single time you are qualifying a lender to see if they are somebody you're going to look at. But then again, also look at what is their performance to close? How many days do they need to close? Do you offer an 11-day close program so you are the same as cash at no additional cost? Only know 2 lenders that actually do that. If you want to know, let me know. Okay. Hopefully this was helpful to you. Remember to subscribe, share this. If you're watching this and you know of somebody that's looking at buying a home or refinancing, hey, share the video. This saves them money because then they actually know what to ask. In the meantime, I'll catch you guys on the next video. Have a great day. Take care.